When most people think about retirement, the focus is usually on saving as much as possible. Max out the 401k, contribute to the IRA, build the nest egg. But here's the part most people don't fully realize. It's not just what you save that matters, it's how you withdraw it that determines how much you actually get to keep. You could work hard, save diligently, and build up a multi-million-dollar portfolio. But if most of that sits in a tax-deferred account like a 401k or traditional IRAs, you don't fully own the multi-million-dollar portfolio. The IRS is a silent partner in those accounts, and every time you take a withdrawal, whether it's for living expenses or because the government is forcing you to take required minimum distributions, the IRS is going to take their cut. And here's the kicker. You have no control over what future tax rates will be. So they could be lower, they could be higher, which means if all your retirement savings are in tax-deferred accounts, you've essentially left a blank check to the government for decades into the future. That's where Roth conversions come in. The concept is simple, but it's powerful. You take money from your traditional tax-deferred account, pay taxes now, and move it into a Roth IRA. And from that point forward, that money is yours. It grows tax-free. It comes out tax-free, and it never requires mandatory withdrawals. In other words, you pay taxes once on your terms and then never again. Now, this sounds almost too good to be true. And here's the reality. Done thoughtfully, Roth conversions can save you hundreds of thousands of dollars in lifetime taxes. Done hastily, they can backfire and leave you with a tax bill that you were not expecting. So today, we're going to break it all down. What Roth conversions are, how they work, when they make sense, when they don't, and how to use them as part of your overall retirement tax strategy. Hi, I'm Mark Wisniewski, president of Southern Incomes. For over 20 years, I've been helping pre-retirees and retirees protect their savings, create reliable income, and navigate those hidden risks that too many people overlook. If you're approaching retirement and want to see if Roth conversions make sense for your situation, click the link in the description below and book a free consultation, and I'll walk you through what your options are. In this video, I'm going to explain Roth conversions in plain language, walk through the benefits, highlight the risks, and show you how people approaching retirement are using this strategy to gain more control over their financial future. If you find this helpful, don't forget to like, comment, and subscribe. 1. What a Roth conversion is. At its core, a Roth conversion is just moving money. You take money from a tax-deferred account, like a traditional IRA, a rollover 401k, SEP IRA, and you transfer it into a Roth IRA. The catch is that when you do this, you owe income tax on the amount that you convert. So, for instance, if you move $50,000, that $50,000 gets added to your taxable income for that year. You pay the taxes now, and once that money is in the Roth, it grows and can be withdrawn tax-free for the rest of your life. Think of it as prepaying the IRS. You're basically saying, well, I'd rather settle my bill now while I can plan for it instead of just rolling the dice on whatever taxes might look like in the future. 2, why Roth conversions are so powerful. Here are 3 main reasons this strategy is so compelling. Reason 1, tax-free growth. If you put $100,000 into a Roth and it doubles or even triples over the next few decades, every dollar of that growth is going to be tax-free when you take it out. That's totally the opposite of a traditional IRA, where every dollar you withdraw is taxable to you. Reason 2, tax-free withdrawals. Having a pool of money that you can tap into without worrying about your tax bill gives you incredible flexibility. It can help you control your taxable income year to year and avoid big surprises. Reason 3, no required minimum distributions. Traditional accounts force you to start taking money out at age 73, whether you need it or not. And that can trigger higher taxes, even impacting your Medicare premiums. With Roth IRAs, there are no required minimum distributions during your lifetime. You get to decide when, if ever, you take the money. 3, the pay taxes once idea. So, when people say pay taxes once and never again, here's what that really means. With traditional retirement accounts, you're essentially renting your money from the IRS because you keep paying taxes again and again, year after year, every time you withdraw. With a Roth conversion, you flip the model. Once you take the one-time tax hit up front, but from then on, that money and all of its growth is all yours. You've closed the door on future tax increases for that portion of your portfolio. Now, that doesn't mean you should rush out and convert everything in 1 year. No, no, no. The key is strategy, which we'll get into. 4, the risks and pitfalls. Before we get too excited, let's talk about the risk. First, higher tax brackets. If you convert too much in a single year, you could push yourself into a higher tax bracket. So instead of paying 22% in taxes, you might suddenly find yourself paying 32%. That's why careful planning is crucial. Second, Medicare surcharges. If you're 65 or older, Medicare premiums are going to be tied to your income. A large Roth conversion could bump you into a higher tax bracket and increase your premiums 2 years later. Third, other hidden costs. Large conversions could impact how much your Social Security benefits are going to be taxable, or even reduce your eligibility for other deductions and credits you're entitled to. So, while the end goal is attractive, lifetime tax-free income, the short-term impact needs to be managed. 5, strategic uses of Roth conversions. Now, let's talk about strategy. Strategy 1, the retirement gap years. Many people stop working sometime in their early 60s, but don't start Social Security until 67 or even 70. During those years, income may be unusually low, and that creates the perfect window to do partial Roth conversions at those lower tax rates. Strategy 2, filling up your tax bracket. Instead of converting everything all at once, many people convert just enough each year to stay within their current tax bracket. For example, if the 22% bracket goes up to a certain dollar amount, you can convert up to that level and avoid spilling into the 24% bracket or even higher. Strategy 3, legacy planning. Roth IRAs can be passed down to your heirs. They will need to withdraw the money over time, but they won't owe income taxes on any of it. For children and grandchildren in high tax brackets, that really pays off. It's a huge gift. 6, scenario 1, the couple who waits. Let's say Mark and Susan, both 60 years old with $1 million in traditional IRAs, plan to retire at 62 and delay Social Security until 67. If they don't do any Roth conversions, at 73, they're forced to start taking required minimum distributions. Let's assume that their account grows to $1.6 million by then. Their first RMD check might be $60,000, all taxable to them. Add Social Security, and suddenly they're in a much higher tax bracket than they ever expected to be in. Over their lifetime, they could easily pay $400,000 or more in taxes on those RMD withdrawals. 7, scenario 2, the couple who converts. Now, let's take that same couple, but this time they decide to use the retirement gap years for Roth conversions from age 62 to 67. They convert $80,000 per year. That adds to their taxable income, but they stay in a manageable bracket. By the time they reach 73, they've moved nearly $400,000 into a Roth. That money will grow tax-free forever. And their required minimum distributions are now much lower. Over their lifetime, their total tax bill could be hundreds of thousands lower. This side-by-side is why planning matters. It's not about avoiding taxes entirely. It is about choosing when and how much you pay so you reduce the lifetime burden. 8 common questions. What if tax rates go down? It is possible. But with the national debt and current tax policies, many people believe rates may rise in the future. In the end, Roth conversions act as your insurance against that risk. Can I convert just part of my account? Yes, and that's often the best way to do it. You don't have to convert everything at once. What about paying the taxes? Ideally, you should pay your taxes with cash from outside of your retirement account. If you use those IRA funds to cover the taxes, you're going to lose some of your long-term growth potential. Here's the bottom line. Roth conversions can be one of the most powerful ways to reduce your taxes in retirement. By paying taxes once and on your terms, you can shield part of your portfolio from any future tax hikes, gain more control over your retirement income, and even leave a tax-free legacy. But the key is planning. Converting too much too quickly can cause more harm than good. The right amount at the right time, within the context of your broader financial plan, is what makes this strategy so effective. If you're approaching retirement and want to see if Roth conversions make sense for you, let's talk. Click the link in the description below to book a free consultation, and I'll walk you through all of your options.